following is an update and technical analysis on the US Treasury markets, where I will begin the technical analysis on the 2-year, the 10-year, and then ultimately the 30-year, the long end of the curve, based upon the daily intervals in which on the 1st of February 2024, we were trading spot price 4.21 off the 2-year yield. And I had mentioned right off the 419 price support in correlation of this primary reactionary uptrend line, call it multi-year price support off the August 2022 major reactionary lows, and that was a critical juncture for any short sellers of the 2-year. We gave you the greatest risk reward ratio to pile in a starter short trade position for a spike in the yield back up to the retest of the inverted parabolic downtrend line and the 236 fibs retracement in confluence of the 50 exponential moving average, and that would be the triple transitioning point of price resistance that would need to be defended by bull traders of the 2-year yield, where short sellers wanted to see this massive spike to the upside, ultimately overcutting the 236 fibs and the parabolic downtrend line. And here's the update. And really to the button, right off that key 419 price support, it was sold off really to the button, right off that key transitioning point, and the entirety of that move to the upside was good for a 12.5% crash in the 2-year bond. Talk about, once again, the charts manufacturing the headlines. We're following the unexpectedly high consumer price index last week, where the stock market really largely disregarded it, where expectations came in for a modest month-over-month rebound in producer prices in January, with a continued slowdown on a year-over-year basis. Similar to CPI, producer prices accelerated, rising 0.3% month-over-month compared to the expected 0.1% increase, resulting in a year-over-year increase of 0.9%, lower than December, but higher than the expected 0.6%. Upon digging deeper underneath the hood, the situation worsened, particularly with producer prices excluding food and energy, which rose by 0.5% month over month compared to 0.2 previously, and an expected 0.1%, and excluding food, energy, and trade, which rose by 0.6% month over month compared to an expected 0.1%. 6x on this represented the most significant beat for core producer prices since January of 2021. And I believe the rug was pulled under everybody's feet. And this changes the whole dynamic off this key inflection point, where we broke out of that parabolic downtrend line, backtested 2 days in a row, right off that 236 fibs retracement and the 4.41 price support. And that was bid heavily based upon 3 days, 4 days in a row there. And that was the technical induced catalyst for a big move, tagging the 50% fibs retracement, only to be rejected pretty impulsively off that inflection point for any active and or day traders in the long end. If you're bull traders, honing in on the 2-year bond there. And I believe we have taken out a major key inflection point with the price support 382 fibs down below. That will be highly regarded by short sellers and or long traders of the 2-year there. That will be the ultimate key inflection point to watch going forward, where short sellers want to maintain this uptrend, maybe with this 50 exponential moving average, and continue to retest the 50% fibs retracement, ultimately overcutting that key inflection point to retest the 618 fibs retracement, call it 4.830 price resistance up above, and that will be a very telling point, probably the biggest key inflection point that will be honing in quite some time, call it a multi-year event. And I believe if we take out the 50% fibs retracement, the stock market will get the memo. Continue out to the US 10-year yield based upon the daily interval, and we have once again reclaimed the 420 price resistance, and that has successfully been defended by short sellers and or bear traders of the 10-year yield. And that is the biggest multi-year price inflection point that we have seen in years on end here, which was overcut and taken by short sellers of the 10-year. And this could be a very pivotal transitioning point where short sellers will need to defend this price zone. When you have almost near-term exaggerated positive divergences, you had very close and telling move here in the technical momentum indicators, with the MACD surging to the upside in a bullish crossover state, overcutting its zero-line threshold, and health is being poured back into a spiking yield, with the oscillator churning to the upside, overshooting its positive divergence, near-term, almost exaggerated positive divergence there, when you had a reactionary low just cutting shy of hitting that major additional reactionary low, but gearing up in what I would call missing the exaggerated positive divergence by the skin of its teeth there. And the divergences have played a significant role within the 10-year, where the 10-year yield is truly the most watched maturity when it comes to government supply. We had a beautiful divergent low. We had positive and or bullish divergences on all 3 key technical momentum indicators, which was the technical induced catalyst for a huge spike up above. backtesting that key inflection point. And what we did was we put in exaggerated. The last time we put in positive exaggerated divergences on all three key technical momentum indicators, that was the catalyst for a major spike here in 2023. And that was a big key transitioning point that really superseded more than double-digit big spike to the upside. Cratering Silicon Valley Bank and a ton of regionals on a big move to the upside, where you additionally put in a nice clean divergent high near term. Negative and bearish divergences constructed amongst all three key technical momentum indicators broke down, where we ended up shorting the 10-year and went long on bonds. That was good for a 20% crash to the downside. And here we are, potentially putting in exaggerated positive divergences once again off a break of this primary reactionary downtrend line. And that has been a significant roll thus far, nearly missing that exaggerated positive divergence, which was an acceleration of this technical induced move to the upside. And here we are backtesting the 420 price support up above, where now I have added three new targets off the 433 price resistance, the 4.492 up above, and the 464.8 yield right up above the 10-year, and in additional price targets to hone in on if you are still riding short within the 10-year yield. We take out the 433 price resistance, and I believe the stock market will begin to get the memo. Taking you out to the US 30-year yield, where I had mentioned once again on a backtest retest of the 4056 price support level that short sellers, enabling them for a great risk reward ratio to the upside. And here it was, huge move to the upside in the spike of the 30-year yield, good for an entirety of a 10.5% crash to the downside, ultimately taking out this primary reactionary downtrend resistance level. And that was taken out with authority there, overcutting its 382 fibs retracement and backtesting this key level once again to go hone in on the 50% fibs retracement, the 618, and additional resistance levels and or targets to go and hone in on for any short sellers who are still short the 30-year bond. And that has been a pivotal inflection point where you additionally have momentum indicators and a bullish crossover state above its zero line thresholds. Make no mistake about it, health is being poured back into the technical momentum indicators of these rising yields. Make no mistake about it, in the ultra long term, based upon this primary reactionary multi-year price support level, we are in a near term and cycle uptrend. Make no mistake about that if and when we hone in on some of these key resistance levels are taken out, where Wall Street might be taken by surprise by a sudden wave of panic selling.